So I'm also going to start with a Slido question, which you'll see on the right hand of your screen. So this question is, how many of these IAASA publications have you read? So we have our financial reporting supervision observations, our financial reporting supervision decisions, our audit quality inspection reports, thematic reviews, our AAPA report, the annual report, and the profile of the profession. So we'll give that a minute and then we'll get the results up. Okay, so this is looking good. So the most popular one seems to be our audit quality inspection reports, followed by our thematic reviews and our annual report. And that is changing as we go. Okay, and what I would say is, if you do have any feedback for us on ways that we can improve our existing publications, or any other suggestions for publications that you'd like to see from us, please do let us know. So in this session, I'm going to cover a couple of items, both internal to IAASA, so looking at our financial reporting priorities for the year end, our changes to auditing standards, derecognition of accountancy bodies, and then looking outside of IAASA at some other Irish legislative amendments, and then an update on the global developments in the audit and accounting environment. So firstly, I wanted to talk about the priorities for financial reporting for the 2021 year ends. There are two key documents that set out financial reporting priorities at an Irish and European level. While both these documents are designed with the regulation of listed entities in mind, the messages do apply to most companies preparing financial statements, so we would encourage everyone to read them. The IAASA observations document is available on our website, and a link is included in these slides, which will be circulated after the session. The ESMA document will be published later this month, and if you're registered on IAASA's website, you'll get a notification from us when that's published. So there are two common themes in those documents that I wanted to mention today. Firstly, the impact of COVID-19, which remains a significant matter in financial reporting. So hopefully we're going to continue to emerge from the pandemic, but companies need to continue to consider and disclose the impact that COVID-19 continues to have on their business and financial statements, and any impact that it might have going forward as well. So it may be that government supports are being taken away, or consumer behaviours have changed long term. And this is all information that is relevant to users. Also, anything that requires the use of forward-looking information remains very uncertain. And disclosures of any such forward-looking assumptions, as well as sensitivity analysis, which would demonstrate the impact of any differences in those assumptions. That's all really vital for users. So most companies have been impacted in some way by the pandemic in the last 2 years. And it's really important to let users know what that impact has been and what the recovery phase will look like for your company. The other common priority item is climate change. So we'll hear from Alan later that there are proposals at Commission level for climate change reporting. However, IAASA and the ESMA documents note that companies shouldn't be waiting for those European changes, and disclosures need to be considered now. So government policies on climate could impact on useful lives of assets, the residual values of the assets, and there could be contingent liabilities or provisions needed for future requirements for remediation or to redesign products to be more green. Moving on then to auditing standards. So the international standard setters have developed a new set of quality control standards for auditors. They're known as ISQM1 and ISQM2. And IAASA has an open consultation at the moment about bringing those standards in Ireland. The new standards require firms to have an integrated and iterative approach to proactively managing quality. So this is a big change for firms and will have a really significant impact on every firm in the country and in the many countries worldwide that adopt the international standards. The larger networks have already been preparing for the change for some time. So audit committees may wish to ask their audit firms about the preparations they are making for these changes. Also, just yesterday, IAASA issued an adoption of a revision to ISA 240, which sets clearer requirements for auditors relating to their responsibilities for fraud. The standard enhances what auditors must do during the risk assessment phase, and then specifies what the auditor does next. So again, we would suggest that audit committees may wish to ask their auditors what impact the standard might have on their audit. The last thing I wanted to mention in this area is that the international standard setters have issued a draft standard which aims to be a single standard for auditing less complex entities. And this has been developed partly in response to the fact that some jurisdictions have developed their own standards for such entities. And the IAASB wanted to maintain some international consistency in this area. So while there is some enthusiasm for this in the market, there are also concerns about the concept of having a different type of audit for less complex entities. So we know that there's already an expectation gap between what the general public expects an audit to do and what the law and standards require an audit to do. And then there's scope, we think, for this less complex entity to complicate this expectation gap further. So IAASA will be carefully considering whether this would be appropriate for the Irish market or not. Moving on to the derecognition point, you may have seen that IAASA revoked the recognition of the Institute of Chartered Accountants in England and Wales in July. And the Institute of Chartered Accountants in Scotland have applied to be derecognised in December of this year. So IAASA and the accountancy bodies have put a lot of focus in recent years on ensuring that people who are on the Irish Auditor Register are qualified and should be there. So there's no longer an automatic inclusion on both the UK and Irish registers. And going forward, it will become increasingly difficult for UK auditors to be eligible for approval in Ireland. EU legislation requires auditors to have practical training with an EU statutory auditor in EU statutory audits. So audits of UK entities will no longer count for that experience. All of this has resulted in these two bodies making the decision to exit the Irish market. This will mean they can no longer issue audit licences in Ireland, and it means that their members will no longer be regulated in Ireland. So from an audit committee perspective, again, first point is you should ensure that your auditor is registered in Ireland still, and also consider whether there's any employees or advisors who are no longer regulated in Ireland, and consider whether there's any impact on that. I'll briefly mention two other significant legislative developments related to companies and company law in Ireland. The first is legislation that is nearing finalisation for the establishment of a new corporate enforcement authority. This authority will replace the ODCE and will have increased powers and functions to investigate corporate crime. This authority will continue to investigate any criminal breaches of company law, including any related to audit. Secondly, for financial services companies, the senior executive accountability regime will be a significant change. So companies in scope will be required to assign specific responsibilities to individuals, and those individuals could then be held to account by the central bank in the event of something going wrong. So this regime will interact with the existing CBI fitness and probity regime. Looking a little further afield then, some recent accounting scandals have focused minds in terms of the European reform agenda. And there's a number of different initiatives in progress at the moment, which could result in significant changes for the audit market across Europe. The first is the Commission's study on the application of the Audit Directive and Audit Regulation. And we'll hear more on this from Alan shortly. In parallel to this study, we're seeing a drive to harmonise both corporate reporting with the rollout of both ESEF and CSRD. So that's a lot of acronyms. So starting with ESEF. ESEF is the European Single Electronic Format, which is electronic tagging of financial statements, which makes them machine readable as well as human readable. So this was due to come in last year, but we were given a 1-year delay by the Commission due to COVID. And companies in scope will now be required to produce their financial statements for December 21 year ends onwards in this electronic format. If your company is in scope for ESEF for 2021 year end, it's really important that you have everything lined up to allow those financial statements to be tagged before your audit opinion is signed. And this could have an impact on your reporting timelines. You may have seen that the FRC Lab issued a report yesterday with the results of reviews of over 50 ESEF reports. And that report said that more than 70% of the companies reviewed had tagging errors. And it highlighted the significant effort involved in preparing financial statements in that format and the potential impact on your timelines. So even if your company is not in scope this year for that, it's worth keeping an eye on it because the scope could increase in the future. And also sustainability reporting changes may require sustainability reports to be tagged in this manner as well. Moving on to CSRD, which is the Corporate Sustainability Reporting Directive. There's a very ambitious target being set for that, with potentially a large number of companies required to comply. It seems likely that assurance is going to be required on those disclosures, and that assurance could be provided by the auditor, but there's also a proposal to open it up to other accredited assurance providers. So given that there are lots of standards that need to be adopted, the timeline for a potential 2023 rollout is really tight. So we really encourage companies to monitor these developments carefully and to start planning. We can see from the Commission's second market monitoring report, which was produced with the assistance of the CEAOB, which is a European body of audit regulators, that Big Four concentration has not changed dramatically since the introduction of the regulations. And this is a regular topic of discussion, along with joint audits and the provision of non-audit services. So it will be interesting to see if there are any proposals going to be made in this area. Lastly, the role of the Audit Committee and the current role of enforcers is also under scrutiny, and it remains to be seen whether changes will be coming down the track, such as increasing requirements on audit committees or reducing the scope of audit committee exemptions, as well as strengthening the role of enforcement agencies across Europe. There are a lot of things happening in the UK as well. So there is a white paper on restoring trust in audit, and that draws together the results of a number of different reviews that have happened in the UK in recent years, including Kingman and Bryden. So the white paper has proposals impacting preparers, auditors and regulators. And some of those are really very significant. And they include proposals such as a new SOX type regime, shared audits, and a new professional body which would only focus on audit and not accounting and audit, as is currently the case. So historically, given the close links between the UK and Ireland, developments there have influenced policy and legislation here. But Ireland continues to be aligned with the EU. However, the developments in the UK are being monitored, and if there's evidence that proposals improve audit quality, they could be considered here as well. Looking a little bit further afield to the US then, there's a new act aimed at holding foreign companies accountable. So in summary, what this act says is that if the PCAOB, which is the US auditing oversight body, is unable to inspect an audit that they're interested in due to a position taken by a foreign regulator for a period of 3 years, there'll be implications for companies. So initially, the companies will be required to disclose that fact. And if the situation persists, the companies may be required to appoint a different auditor. Now, for those in Ireland, this will not be an issue because IAASA has an agreement with the PCAOB and we facilitate joint inspections of audit firms who are in scope for PCAOB. So I've just included some useful links to some of the documents that I've discussed, and I will maybe turn over and see if there are any Slido questions at this stage. Okay, so the first question is, is the ESEF electronic tagging of financial statements the responsibility of the auditor or the company or directors? And it is absolutely the responsibility of the company and the directors. Auditors cannot do this for you. They do have to audit it, but they cannot do it for you. That's a prohibited service. So you need to arrange your provider, if you're going to use an outsourced providers, to prepare this document for you and then hand it to the auditors in time to have it audited for your reporting deadline. So it is really quite onerous, and there's a lot of planning involved in this. And what we've seen from other countries and heard from other countries who may have done this last year is that really don't underestimate the amount of planning involved. And I think the phrase regularly used is test, test, test. So another question, have I seen or read anything to date in the Bayes report that I could see being taken up by the Irish regulator? So what I would say is, for the most part, the proposals are legislative proposals. So that would be a matter for the Department of Enterprise, Trade and Employment rather than for IAASA. However, we are monitoring them, and what we would like to see, I suppose, is evidence of the impact that these proposals would have on audit quality. The other significant proposal in that legislation is replacing the FRC with a new body called ARGA. Now, lots of the changes that are involved in that actually will make ARGA set up in a much more similar way to the way IAASA is already set up. So we're probably a little ahead of the curve on that. So another question there, which is the required set of accounts for the Companies Act, true and fair purposes, the paper-based set or the ESEF? So this has been examined, and it is a matter of legislative interpretation, but we have been advised that your statutory financial statements, so these are your Companies Act financial statements, they are your ESEF tagged financial statements, which means that they're required for audit. that's what you file with the Euronext Stock Exchange and also with the CRO. Next question, should Ireland now start looking more towards the EU and less to the UK in these areas? Yes, and I think, as I mentioned, historically there have been close links, and indeed the UK have been quite influential in Europe, but Ireland is very much aligned with the EU now, and not sort of automatically following what is happening in the UK. Okay. So I think that is all the questions then that are in for me. So I will pass you over then to Martin Kelly, who's going to talk to you about audit reports.